Here we have accounting concepts, accounting A-level class, accounting concepts and conventions. So we're going to start with accounting concepts. When we talk about accounting concepts simply means rules or guidelines that must be followed in the course of preparing an account. So we don't just prepare accounts, we prepare accounts based on certain guidelines and rules. So when we prepare accounts based on certain guidelines and rules, we call it accounting concepts. Do you understand the accounting concept here? Good. Then we have the fundamental concept itself. For fundamental concept, we are simply talking about those principles that we've incorporated into our accounting standards. So we have accounting standards, which is the international accounting standard. So these accounting standards, it is standardized. It means we cannot go beyond it. In as much as we are preparing our accounting, here, there, anywhere across the world, it has to be the same. That's why we call it accounting standards. So those the accounting concepts, the principles that we've incorporated into our accounting standards are called fundamental concepts. So that's fundamental concepts. Then we go on to the fundamental concept. We have the going concern. For going concern, that's the first one. For going concern is simply talking about businesses should be run as if they're going to last forever. So in as much as we are recording our transaction, especially the assets, your assets should be run, you should always ensure that you give the value for your assets in terms of the carrying amount, not the market value. Because when you think about the market value, it means you want to sell your business. But you must not sell your business based on the going concern concept. The going concern concept is talking about you as a business running the business as if it's going to last forever. So if you are running the business as if it's going to last forever, it means you must always record your transaction based on the cost less depreciation. That is the carrying value, not the market value. Because when you talk about the market value, it means you want to sell off your assets. But you must not sell off your assets. That is going concern concept. Then we have the consistency. For consistency, it's simply talking about a continuous method you use when you are operating your account. So this means whatever transaction you do in accounting, the formula, the method you use must always be the same. So for example, we're talking about depreciation. For depreciation, we're talking about the wear and tear of an asset. So the wear and tear of an asset, if you use the straight line method for calculating your assets in the first year, in the next year you must use the same straight line method. You don't use straight line method today, you use reducing balancing method tomorrow, you use revaluation method after tomorrow. No. So whatever accounting method you use, it has to be used all through your accounting years. So that is what consistency is about. Continuous usage of your accounting method. That's also another concept of accounting. The third one here is prudence. For prudence, this is an accounting principle which makes sure that assets and income are not overstated and liabilities and expenses are not understated. So most of the time, a business might incur more liabilities. As soon as it incurs more liabilities, it has to say the liabilities the way they are. Not like, oh, you want to make it look good in the eyes of the stakeholders. No. Whatever accounting values you have, you must not overstate or understate them. You have to state them the way they are. That is prudence. Assets, I'm going to say assets. Prudence means your assets and the revenue. These are the benefits of the business. Assets and revenue are the benefits of the business. Liabilities and expenses are the cost to the business. Yes or no? So when you are stating your values in terms of assets and revenue, you must not overstate it so that you look good in the eyes of stakeholders. You must not look good in the eyes of stakeholders. Whatever the value you have, just write them down when you are preparing your account. That is prudence. Your liabilities and your expenses, you should not understate them. Because when you do understate them, it increases your profit. And that is not part of accounting concepts. Your profit must not be understated. Your profit must not be overstated. And for you not to overstate and understate your profit, it means you have to be prudent. And being prudent means your assets are recorded the way they are. Your liabilities are recorded the way they are. Your liabilities are recorded the way they are. Your expenses are recorded the way they are. Your revenue are recorded the way they are. So for you to record your assets and revenue the way they are, it means you would not overstate them. for you to record your liabilities and expenses the way they are, it means you are not understating them. Because if you do understate them, you're going to have more profit than what you are supposed to have. That is the principle of prudence. I think it's clear. So we'll go on to accrual concepts. For accrual concepts, we're talking about the matching concept. So I wrote, it is an accounting term used to describe the process of recording income or expenses when they occur rather than when payment is made. So for accrual concept, is the matching concept. You record your transaction the way they are. So if you have incurred expenses, you record this as expenses in terms of expenses. So if you are thinking about selling a product, your revenue should be matched with your cost. Whatever you make profit, you should match it with your expenses. So don't record profits today and for this year, then you record expenses for the next year. No. Whatever expenses you incur this year, you have to match it with your profit. So that means your cost must be deducted from your revenue to make your profit. You must not take profit this year and take revenue or cost the next year. You have to match them the same year. So profit for this year should be matched with the cost for this year. That is accrual concept. Is it clear? Then we go to other concepts. We have historic cost. For historic cost, I wrote, it implies that assets are recorded at their actual cost. Because I bought a laptop now. If I buy a laptop now, the value I bought the laptop is what I have to record in my account. Because if I do not record it, it becomes difficult for you to trace when you are doing your audit. So assets should be recorded with their value, the value that they have been purchased. That is historic cost. Then we have money measurement. For money measurement, which is part of accounting concept, all items recorded must be those with monetary value. I'm teaching right now. You might employ me as a teacher, but you cannot record my quality in terms of money. You can only record my salary, the amount of money I make. So accounting, when you prepare in accounting, it's an accounting concept that you only record items that have monetary value, not abstracts, not quality, not skills. Skills cannot be measured. Quality cannot be measured, but the salary of the employee can be measured. So you record the salary of the employee, not the skills of the employee, because you cannot record the skills of the employee. That's about that. Then we have business entity. We're talking about business entity. It's an accounting concept that says that you separate the owner of the business from the business. When you record the owners of the business from the business, it simply means you're treating the owner separately from the business. And one way to do this is about the capital and drawings. For capital, that's the amount of money the owner of the business put into the business. So it means, why do we have capital? We're having capital because we want to separate the amount of money made by the business and the amount of money invested by the owner of the business. Because the business has to be treated separately from the owner of the business, especially for private limited companies and public limited companies, that they have limited liabilities. So the liability of the owner of the business should be separated from the liability of the business. That is the point there. So to do this, we use the business entity concept, which states that the owner of the business must be separated from the business. That's why when the owner of the business invests money into the business, we call it capital. And as soon as the owner of the business takes money away from the business, we call it drawings. So that's why we have capital and drawings. Drawings. When the owner of the business takes money from the business, we call it drawing. But when the owner of the business puts money into the business or invested money into the business, we call it capital. So that's why we have the accounting concept for business entity. Is it clear? So we have the activity. No, we have materiality. For materiality, here I wrote. There's materiality. Are you there? It is an accounting concept which states that all materials items should be reported properly in the financial statement. As soon as you have your items in your financial statement is your statement of profit or loss, your statement of financial position. So whatever items you have, they have to be recorded accurately, because if you don't record them accurately, you won't balance your transaction.
Okay.
So you have to balance your transaction. That's for materiality. Then we have realization. For realization, it simply means revenue should be recognized in exchange for the goods and services. So it means if I'm selling a product to you, I can only record it as a product, as a sales, if you have accepted the liability. Get the point here? If you are buying a product from me, I wouldn't record it as being sold until you accept the liability. That, oh, I have bought this product, I'm going to pay for this product. That is what realization is about. So revenue should only be recorded as soon as the third party or the customer accepts that the liability is his or hers. Is it clear? Any question about that? No. So we have the activity. We have the activity anyway. So for the activity, still on. For the activity, activity 1. I'm going to read the question and give you the answers anyway. It said an amount of £4,000 due from trade receivable A was written off as an irrecoverable debt. Is written off as an irrecoverable debt. It's irrecoverable debt because you are unable to retrieve that amount due from the customer. So that is the principle of prudence, which means you won't be able to overstate your profit or understate your liability. So you see it as irrecoverable debt. It means it's going to be an expense for you as a business. So that allows you, that brings about the concept of prudence. Is prudence clear? Mm-hmm. The second one, inventory of £9,000 was written down to its net realizable value of £8,000. Inventory of 9,000 was written down to its net realizable value. If it is written down to its net realizable value, that means the value it will be sold in the subsequent year. That is also prudence. You are not overstating your profit. You are not overstating your revenue. You are not understating your liabilities. You are not understating your costs or your liability and what? No, your liability and your expenses. So the third point, 1,000 paid for private travel was debited to drawings. So this is business entity. The owner of the business paid. The owner of the business has a private travel, and 1,000 was paid. In as much as it's recorded as drawing, it means it's for the owner of the business. That is business entity.
Business payment.
Yeah, entity. Then we have motor vehicle were depreciated at 20% on cost. If motor vehicle was depreciated at 20% of cost, these are two concepts. We have matching concept and prudence. Matching concept because the asset has depreciation. It has asset has to be merged with depreciation, and you don't overstate your profits or expenses. That's prudence. The next one, and a tablet was written off as an expense, even though it could last 3 to 5 years. That is materiality. Okay. It's a tablet. A tablet, you know a tablet, right?
Yeah.
So the value has been recorded. So it means it has a value. That is the material. That's materiality concept. The next one, second to the last one. An electronic goods business has asked staff to show customers how to operate certain tools. This is considered to be worth 50,000, but it is not recorded in the books. Listen again. An electronic goods business has staff, as workers.
Money
who show them, no, it is money measurement. Okay. Why? Because we cannot record the expertise or the quality of the worker. We can only record the value, the amount of money paid to the worker. So it's a principle of money measurement. And the last one, depreciation is charged. Depreciation is charged at 20%, but we want to increase it to 25% for this year only. So for this year only means subsequent years we go back to our normal method. That is the principle of consistency. So that ends activity 1 on accounting concepts.